What you're about to hear is a conversation that I had with two very prolific investors in the Upstart community, Eddie and Henry. I'll put all their links to their Twitter accounts down in the description down below. You can check them out. But they're retail investors with very strong opinions about this amazing lending technology company. I don't personally own Upstart stock. It's something that I just simply can't pin down what their valuation should be. That being said, I know that their product is very well done, and it's something that, if done right, could be unbelievable into the future. A quick shout out to the sponsor of the video, public.com, but more from them later. Ladies and gentlemen, thank you so much for joining us. I got Eddie here and Henry. These are two amazing Upstart investors that have covered this stock relentlessly for the past, how long has it been, guys? It's definitely been over a year now.
Yeah,
Probably about a year and a half.
Year and a half? Okay. I'm here to learn everything I can about Upstart, the ups and downs of this company, which have been maybe the most volatile that I've seen in practically any stock. Even they will agree with me. But let's just jump into it. What do you guys think about this stock at this current moment?
Yeah, so I guess I'll just jump in first. So Upstart, obviously everybody's topic of conversation. It ran up 450% year to date. Yeah. Then it fell like 50% from its peak on earnings. And of course, you had a lot of shorts that were shorting the stock, which caused a short squeeze. But you also had a significant improvement in the fundamentals, which is something that most people don't realize and a lot of people neglect to see. So there's more behind Upstart than just the cyclicality of lending. Certainly not a predatory lender in my view. There's a lot behind this stock, and there's a lot of fundamentals that have attributed to the rise in the stock's price as well. I think Eddie would agree with me too. It didn't deserve $71 a share, and we've been pretty vocal about that, but certainly deserves to be up off the lows.
Eddie?
Yeah. So I actually sold out of Upstart last year after the May earnings, and which was just bad, and it just fell off a cliff. And I decided to stay out of it until they announced committed capital in Q1. That committed capital to me was
Q1 this year. You mean just
Q1 in 23.
Yeah.
In Q1 of 23, they announced $2 billion of committed capital over the next 2 years. My thesis around Upstart has been that they have a supply problem, and that supply problem is getting cash in to fund their loans. And so getting that $2 billion in committed capital would enable them to reaccelerate revenue. I was excited for Q2, and I was hopeful that they would get another $2 billion in committed capital. That didn't happen. So the with shares up at 71, had they announced more committed capital, I think it would have gone higher, probably above 100 in my opinion. But
that's so crazy for this stock, that small changes in this business, because I think last time I had Henry on, they really do have unlimited leverage in a way. If they can find partners to fund their loans, they're not like a traditional lender. This is a tech company that's offering the solution for lending, right? If anyone, actually, we should have given a 60-second rundown of even what Upstart is. Henry, can you help me out with that?
Yeah, so Upstart is an AI lending marketplace, if you want to phrase it that way. In traditional times, they don't hold any credit risk or loans on their books. Obviously, that business model was changed throughout this down cycle because they couldn't sell loans that they were originating, so they held them on their balance sheet. Management said it was because of R&D, kept snowballing, kind of turned into a disaster, but we've seen some steps being taken to mitigate that risk and offload a lot of that credit risk that they had. So traditionally, Upstart, what they do is they take non-traditional metrics. So they're evaluating you with more than just the FICO score, and they serve non-traditional people. So they're able to, and they partner with banks. So by doing so, they're able to leverage banks' low cost of capital to provide more borrowers with more loans at lower APRs than traditional lending. And so they make money when partners originate loans. They get origination fee. Upstart gets the origination fees, and they get a percent of the interest payments as well. And ideally, they hold zero credit risk. So in 2021, when this was booming and the economy was booming, it was super leveraged and it was infinitely scalable and everything was going great. And then obviously the Fed raised rates and Upstart got crushed, held on to loans. And what we saw was that credit risk become amplified. Upstart started to incur a lot of losses. Vintages began to underperform. And I think there's a lot we can touch on there. Just briefly, when you're evaluating new borrowers with new metrics, of course your vintages are going to underperform at the beginning because you're taking a new stab at evaluating new borrowers than
So
traditional lending.
okay. So what do you think about them getting into all of these new style of lending, like auto or
Yeah.
HELOCs or
So
small dollar loans?
this
They're
is this is
essentially going to
huge.
underperform, right?
It's an interesting way you phrase that question. I think they will underperform at the beginning. And Sanjay actually agreed with that in the latest conference call. He said that they were selling auto loans in an ABS deal for lower than what they were marking them down. And he
Yeah.
said investors could attribute that to R&D expenses, which, like I said on the previous live stream, I can take it or leave it. But I mean, those vintages are going to underperform in the beginning. But what's important is that Upstart's ability to expand their footprint into auto, they grew into 12 new states this quarter, I think, something like that, and HELOC markets helps the durability of their business, and it helps them reduce their cyclicality because unsecured personal loans are taken out in good times. In bad times, people borrow against their car, or they take out a car loan because it's an ABS, so people are more likely to fund that loan, or they borrow against their house. So this durability helps set Upstart up to be less or more resistant to any macro headwinds. And with bankruptcy off the table, in my view, the thesis is somewhat simple. If you believe the Fed funds rate will go down, which I think all of us would agree it will in time, if Upstart weathers that storm and survives until then, they're set up to launch with more data, more bank partners, more committed capital will flow in, and they'll have more segments of their business which are counter-cyclical. So I find it hard to imagine that Upstart will suffer such a catastrophic fall again in the future now that they have all these new measures in place. So I think we've seen probably the worst of Upstart's business.
Sure.
Just my take on that there.
So I guess one of the problems that I also had whenever I was reading the latest quarter is that they have this best rates for all slide on their presentation where they talk about how they're comparing versus the traditionals. Eddie's shaking his head. I hope that you know the one I'm talking about, where in Q1 they compared it against the large US banks and how much better they're performing. And then in the most recent quarter, they actually compared it against credit-only models. Can you explain that? Because I find probably most large banks are not using credit-only models. I'm sure no one is using credit-only models.
So, can you hear me?
Yeah. Oh, yeah.
Okay. So, yeah, I've had an issue with that as well. That them comparing themselves to FICO, like that's
Sure.
when you see the graph on their presentation. They
Yeah, I meant credit score, not credit only. My apologies.
Right.
Yeah.
So I would imagine that they use FICO as one of their AI inputs to approve or not approve loans. I think that's an unfair comparison. It's hard to know how well their AI does or doesn't work.
Yeah.
But
It's a black box.
But what we can
most of the factors.
Right. But what we can definitely see is revenue from people who are willing to put money into these loans and hold them on their balance sheets.
Yeah.
And in 2021, as Henry stated, it was quite the growth curve, and they became very, very profitable. This isn't a company that's never been profitable. They were very, very profitable.
So have they had any recent commentary on, as the macro improves, how many partners that they're in talks with? I know that they've signed about 100 partners that actually do deal with them, but are they talking to new partners that they're potentially trying to sign up?
So let me touch on this a little bit. Dave Gerard has said in the past that partner adoption was not going to come super quickly, but that when it did, it would be like a huge inflection point and partners would grow rapidly. Like I'm talking like a 10x in a year. That's what he said. So I think it's unlikely, obviously, for that to occur in this macro. So slow and steady partner growth is probably what you want right now, because I'm not even sure Upstart's business is ready to deal with large scale right now. I just think they're still weathering kind of what happened to them in 2021, and they're still trying to learn and perfect their models. So they might want to stay kind of, hey, we're just floating around weathering the storm till we can become better. Then we're going to go and really focus on capital expenditures or marketing expenses, which they've cut drastically to try and get new partners and originate more loans. I think they're more so trying to perfect a lot of the intricacies of their business that were somewhat thrown underwater in 2022 before they get ready to ramp up with new partners. And something else that I want to touch on here, a couple points. So first is this new thing that they're doing, just announced this quarter, to evaluate how vintages are going to perform or how they're going to underwrite their loans. It's called parallel timing curve calibration. And so what they're doing is they're looking at loans that they underwrote a year or two ago, and they're re-underwriting it with the data that they have now and seeing how those loans would perform if they were underwritten with what they have now. Now, it's not a back test because they're not technically back testing the loans. They're just seeing how they would perform differently with new information, and they can use that to help predict how their loans are going to perform in the future, because some borrowers might have really overlapping financial situations or things of that nature. And just kind of to go off of that, there's a story of Gerard, who, for people who don't know, he worked at Google Cloud, or he basically founded Google Cloud at Google. He was one of the large creators of that. And he did hiring as well. And he said that when they would hire people to work at Google, they would look at super small technicalities. So, for example, if somebody's GPA was a 4.0 straight throughout all 4 years, Google would actually consider hiring somebody who had a 3.6 to a 3.7 to a 3.9 to a 4.0. Progression in academics actually showed to be really important for them. So where I'm going with this is, I think that it's very possible that Upstart's models, when you talk about how they're separate from FICO, are evaluating a bunch of little pieces and little intricacies like that to help evaluate borrowers better. And those things take time to perfect. So when we're talking about...
So sorry, I just want to understand really quick about this simulated sort of going back, like, I guess without telling the new algorithm that these people had potentially defaulted, putting their same application through this process, there might be a higher increase for, hey, we never would have offered this person a loan in the first place through this new model. And then now we actually know, because that, those cohorts have matured, that, certain people have defaulted or potentially didn't work out as well as we thought. And now they're saying, all right, so are they saying that they're just testing this, or that it's working, saying that our new algorithm is showing better results?
Well, it was just announced this quarter, but as we talked about in the past live stream, Tanner, they are sharing 40 million in credit performance risk with their partners. And those vintages return 28%. And I would assume that they're using this parallel calibration to figure out, how are we going to underwrite these loans? Let's see what they would have done a couple of years ago. And so assuming that they're using that to do the risk sharing, it would suggest that that curve calibration is actually working quite well. Now, of course, that's all a little preemptive and it's not a ton of money, but I think it's probably just in its initial phase up, like HELOC loans.
Eddie, how big of a problem is this credit sharing?
It's hard to quantify. So I don't personally think it's a huge issue. I think it's a much smaller issue than the situation they were in before, when they couldn't get loans funded. That was a bankruptcy risk, had they not been able to get funds loaded or loans funded. But now they've got $2 billion in committed capital. As long as they're originating probably $6 to $8 billion of loans a year, I think they're just going to be able to tread water. As soon as you get the HELOC product on board and the small dollar lending, those are the two products that I'm most excited about that are going to be coming out. I think that their revenue is going to reaccelerate. And that's assuming that the Fed funds rate doesn't drop between now and then. If the Fed funds rate starts dropping, then their legacy business, the personal loan business, that can start advancing as well.
Okay, so help me understand this, because the small dollar loans essentially is what all banks are doing already, but we just call it overdraft. Whenever people are spending past the amount that's in their account, if they're spending something that's not their money, they're getting a loan from the bank, essentially, and they're going to pay really, really high fees for doing so. In that case, Upstart can come in and so whenever someone is given overdraft or whatever,
those people's credit is being assessed to even say whether or not their card is going to get declined or they're going to go into overdraft? Because I didn't even understand that, or I guess I wouldn't even have thought that was the case.
So my understanding of the small dollar loan that they're trying to come out with is that if a bank would sign up with Upstart, and that would be a white label service, and instead of charging overdraft fees, let's say you as a consumer opts in to this small dollar loan product, and then when you spend more than you have in your account, you just automatically get funded $100 into your account. And then you're not getting charged the overdraft fees, and instead you're getting charged interest. So the reason why the banks would want that is because the regulators have been strongly encouraging the banks to stop doing these overdraft fees. The regulators don't like these fees. And so this is a way for the banks to continue making money while also appeasing the regulators.
Okay, so how I get that. It seems like a loophole in that case, but I mean, they're used all the time in that case. How big is the total addressable market here for these small dollar loans?
Well, they've described it as a payday lender killer, and the payday loan market is like gigantic. I don't think the way that I just pitched it, my understanding of it, would translate into a payday loan killer. But I do think that it has the potential to be a payday loan killer. The reason being is payday loans, like when you annualize the interest that they're charging on those things are over 100% interest annually.
Wow.
Upstart, because they work with banks, they have to cap their interest at 36%. Upstart has said that the reason why payday lenders have to charge over 100% is because they have automated underwriting processes. And because they are automating this issue, they're going to be able to charge under 36% to get under that cap that the banks need, but also be able to compete with the payday lenders and take some of their market share.
But so this is such a tiny loan done at such a high frequency.
Correct. Yeah. So so it'll be across, millions and millions of people, but small dollar amounts each loan.
Is this being done traditionally from anyone else? These small dollar loans, aside from paid, but I mean, like at large banks, are they offering this credit solution instead of overdraft right now?
Not that I'm aware of. If anybody is aware, I would like to know.
Upstart stock can be extremely volatile, and it's why some investors like to take some chips off the table and put their money into some safer investments to cash in on some very high yields. For example, did you know that you can earn up to 5.5% on US-backed treasury bills? That's higher than most high-yield savings accounts and even all of them that we cover on this channel alone. But that being said, the high-yield savings accounts still don't come with fixed rates. So potentially, if interest rates start to fall, so will the high-yield savings accounts. Well, not with treasury bills. Once you actually sign up for them, the given rate is fixed, and therefore, until your maturity, that's the amount that you'll actually end up earning. But there's a problem. Everyone knows treasuries are great, but retail investors don't have a lot of treasuries simply because they don't know how to buy them very easily. It gets complicated. You have to go on a government website that looks like it was designed before I was born and navigate a very complicated process all on your own. This is where public.com comes in. Public.com actually created a treasuries account that allows you to purchase treasuries without having the stresses, complications of that website, but yet still benefit from things that we would usually see whenever getting into these nice fintech companies. I'm talking about things like no minimum hold periods and no settlement delays, so you could put it in for as long as you want and pull it out when you need to. Or the fact that public.com, if you completely just want to continue to invest in treasuries, they will automatically put you into the next maturity. Don't worry, like I said, you can pull out any time. But that being said, if you are going to leave the money there, it might as well be good to know that you're going to continue to earn great interest on that money. And lastly, the fact that it's just a government-backed product. This is still treasury bills that we're talking about, which means it's an incredibly safe place to park your cash. So you can manage your treasuries on public.com and even do all your sorts of trading, whether it's ETFs, crypto, or buying stocks like Upstart itself, all on public.com. Go to public.com/future investing to start earning 5.5% on your cash that's backed by the US government. Remember, that's public.com/future investing.
So let's segue a little bit because I want to talk. Eddie mentioned conversion rate and that being impacted by the 36% APR threshold, which is true. So borrowers, if Upstart were to underwrite them at over the 36% APR, they would not be given the loan. Something to note is that Sanjay, the CFO of Upstart, said borrowers who are being rejected because of that aren't going elsewhere. They're just not getting a loan. So that's important. And the second kind of thing about that is people are going to say, well, 36% APR is super predatory. Well, let's think about it this way. Number one, it's an unsecured personal loan. There is no collateral. The collateral is a higher interest payment. So that's something to keep in mind. Number two, these borrowers don't have anywhere else to go. A lot of the borrowers that Upstart serves are immigrants or people who have no credit history at all. So they don't even have a shot anywhere else. And I'd like to share my screen here if I can figure out how to do it, because
well, while you're bringing that up, because I'm the conversion rate, you're from what I know, you're so right about the the higher the actual macro environment is the Fed's funds rate, that meaning that the threshold doesn't change, the threshold doesn't continue to climb, which means the conversion is obviously going to go down if there's a really risky borrower that would get pushed out of that threshold.
Right. And of course, that's
case, how big of a deal is it that we went from 8 to 9% in a raising environment?
Big deal. That's
what I'm thinking, right? Like
with lowered, they cut marketing by 77%. So that's also keep that in mind. Now, this is what I have.
That's year over year?
No, that's quarter over quarter sequentially.
Wow. Do you mind if I interrupt real quick? So I think that change from 8 to 9%, management was talking about how right now they haven't rolled out the small dollar loan product. But what's happening is when someone is denied a loan through Upstart for their standard personal loan, their legacy business, the way that they're testing the small dollar loan product is they're then offering them a small dollar loan. So I'm wondering if that conversion rate is ticking up as a side effect of them offering these small dollar loans to anybody who's denied a loan through Upstart.
Okay, so
that's true.
We won't give you $4,000, but we'll offer you $100.
We won't give you $4,000, but we'll give you $400.
Okay.
But keep in mind too, the conversion rate was obviously crushed because they refused to expand their APR threshold. But if the Fed cuts rates, naturally more borrowers will be approved, because if you think of it as a pendulum, it's going to swing the other way. So like I said earlier, Tanner, and the other live stream, it's a double-edged sword. A lot of everything that Upstart does is dependent on what the Fed is doing. So what I have shared here is the ESG report for Upstart. And there are a lot of people who think Upstart is a predatory lender, which I think is not well grounded. It's just because a borrower pays high interest on an unsecured personal loan doesn't mean it's predatory. Like, it costs money to borrow money. And so, I mean, just reading this, if a borrower is delinquent on their loan and facing difficulty making payments, Upstart's going to contact and let them know about loan modification options. Some more stuff there. Temporary relief programs. If eligible, the borrower may be granted temporary relief for up to 6 months. So I'm not extremely well versed in traditional FICO lending, but my gut tells me if I have a loan with Wells Fargo and I can't pay it, they're just going to say I'm out of luck, and they're going to try and figure out some way to force me to pay that loan. It looks like at least Upstart has some modification programs if you're eligible. And keep in mind, if you're on the topic of predatory, Upstart is also approving more borrowers, and they're successfully approving more minority borrowers. Hispanic and Black borrowers are being approved at higher rates with Upstart. And the data literally shows that they are experiencing lower default rates than FICO. So yes, they are factually increasing access to credit to a bunch of different groups successfully. Now they're doing it today at a much less successful rate than they were in 2021 because interest rates have gone up. So obviously that spread has compressed. But like we said, it's cyclical business. And when the Fed cuts, that's going to be cyclical as well, except it's going to be for the upside. So I won't mention all the points that I made before, but when you're cutting expenses and gearing up and your models are learning and your data is working, you have more partners, you're setting yourself up well. Now, of course, there's still risks for Upstart, as with any stock with this high of a beta, there are obviously underlying risks. So I'm not saying that you should go all in, but certainly much, much more to the eye for Upstart than predatory lender, cyclical, down 90%. Like, that's just too surface.
Yeah, I mean, I wonder because if you guys have these answers, are they kind of talking about, because I deal in new bank and stuff like this, and they kind of pride themselves on offering solutions to unbanked individuals, and so you kind of have to offer a higher interest rate because the people have never seen credit, so
Yep.
you're kind of taking a risk on someone that has no history.
So didn't
How are they sourcing their data from someone that might not have any payment history previously?
Yeah, I'm not sure on that. Tanner, you had growth to value on it, and I think he told you a story about an immigrant friend of his who came to America and got a loan with Upstart with no credit history. I think a lot of what Upstart does in evaluating that is black box. That's why I think a lot of it is
Yeah.
proprietary. And when the data that they're telling us is saying that it is working, I think you just have to take that as is. So that's the assumption that I'm making, is that the data that they're telling us is correct. In which case, they're somehow figuring out a way to do this. But keep in mind that Upstart has been doing this since like 2013, 2014. So
Yeah.
it's not some new AI company riding the trend. Like, they were doing AI before AI was cool. Very similar to Palantir in the sense that Palantir was organizing and helping people make decisions with data before that was cool, and it's a big black box what they do. So I
Yeah.
think there is some overlap between those two business models.
That's exactly what I was thinking. Honestly, I was thinking Palantir because like we have better solutions than the competitors, and you're gonna have to trust us because we don't really show you how the sausage gets made.
Right. That
But
makes for a
then
divisive stock.
yeah, the trust, and maybe they should start following in the footsteps of Palantir in the way where they do these conventions and get their customers like real testimonials for how it's working.
Mhm.
Because I wonder like how their sales teams are actually pitching this, not to customers, but to other banking institutions.
Yeah, that's one thing that I'm not fond of Upstart. I think Gerard's a very controversial CEO. I think he's good in the sense that he's not flaunting around and doing all this big talk. I like a CEO who's kind of just doing his job and doing it hopefully well. But
Sure.
I would love to see an investor day from Upstart, similar to what Palantir did in present. I know Eddie's gonna know what I'm talking about. Tyson Foods, where the
Hmm.
Tyson Foods CEO was presenting how Palantir helped them. That would be amazing. I'd love to see that from Upstart. I've written multiple emails to IR, no response regarding such. So I
Sure.
think that management could definitely be taking additional steps to basically reinforce investor confidence. And I think that's a large part of the reason the stock is so cyclical and has had so many peaks and troughs, is because management does not do a good job communicating what they actually do. You have to sit there and analyze it and spend a considerable amount of time looking at the data to actually understand what they do, why it may work, and etc. So
Can we talk about some more future growth perspectives or prospects? Because I really like that. It just gets me hyped up. So,
sure,
Eddie, you're really excited about HELOCs. Why?
Yeah.
take it away, Eddie. Take it away.
Yeah.
So the product that Upstart started with is really the hardest problem, in my opinion, in the financial services industry, and that is giving money to someone with no collateral.
Yeah.
And as soon as the Fed funds rate started going up, so let's say that you're a buyer of a loan. As soon as the Fed funds rate starts going up, you're now having to decide between, do I want to buy this personal loan that's going to pay me 12% and they could possibly default on it, or do I want to buy a 3-month treasury that's going to give me 4%, and if you annualized it. That makes the 12% personal loan less appealing, and the value of that loan will go down.
Right.
The thing with home equity line of credit is, it's securitized by someone's home, so that's a big deal, and they're very likely to make that payment as long as they can. And B, something that we've not yet touched on in regards to Upstart with their HELOC product, the goal is to have this funded 5 days from application, 5 business days. I applied for a HELOC myself earlier this year. It took me over 35 days to get my loan funded.
I was gonna say Upstart. I think they said the average like 29 days or something, right? And they want to
It's
bring that down to
ridiculous.
5.
Yeah.
Right. So this is a huge market opportunity, in my opinion. I think even with the Fed funds rate high, this debt is absolutely more desirable than personal loans for asset managers. And I strongly believe that this is going to help boost their revenue as they roll it out. They just said that they started a pilot in Colorado, and they said by the end of Q3, they'll have a few more states. I believe one of those is including Michigan.
Right. I guess another thing that I think is so important to the Upstart, I guess, thesis or whatever is back whenever they were a $400 stock, maybe some would be convinced that that was overvalued. But honestly, their earnings
not
were
that
going
overvalued.
sky high.
No.
Like,
Yeah.
they were actually demonstrating extremely large growth. And the reason why I went from 400 down to 10 or $11 or whatever was a complete destruction in macro, and meaning no one wanted any sort of they wanted no part in buying any more personal loans in a rising interest rate environment. And that's not an Upstart problem. That's just a lending problem in general. If you can get a loan and have to secure your money at making 3%, or well, I guess for a personal loan, let's say 7%, or wait and then get it at 13, 14%, well, then you would wait. You know what I mean? The banks have the waiting game. Upstart doesn't. So they got crushed. That being said, they still have 100+ partners. Is there any sort of dropping of these clients, or do you think as the macro sort of drops, everyone that they had back at 400 and all the new people that they've acquired, meaning banking institutions, will come back to fund Upstart back whenever they do actually want to get back into, a bunch of personal loans?
So I think partners are obviously just naturally going to originate more loans as the macro becomes more favorable. And what I think most people don't realize is that the credit markets are going to bottom before rates top, most likely, and before the economy recovers, because people are going to front load it. And so what Upstart's job right now is to convince these institutional investors that our high yield, high risk vintages are worth your money versus XYZs, because there's a surplus of those available. And so their vintages, I think, are returning now 11 point something percent, which was up drastically year over year. It was like 3% or something. So they're improving their vintage performance, and they're doing that small risk sharing model, which to share credit risk with partners temporarily, hopefully as a proof of concept. If that continues to build up, then that might be a red flag. But they're doing that to kind of prove that we're confident in our data. And just as a reminder that they're confident in their data now because of that new parallel curve calibration, where they can basically re-underwrite previous loans that they did with the data that they know now. And that's going to help them boost performance. And I think something else that people should keep in mind is that partners are going to sit there and look at Upstart and be like, okay, when the cycle is over and the next bull run starts, Upstart survived. And a lot of the loan durations on Upstart loans don't expire necessarily this year or next year. Like, some of them are going to go into 2025, 2026, 2027. So as we move out of this stage of the economy and we transition into a new bull run, hopefully, they're going to look at these vintages and see, how did they actually perform in the long run? Did these borrowers do well? And if Upstart's data truly works, which is what this data is suggesting, then these vintages are going to do extremely well, which means it's going to be easier in the next down cycle for institutional investors to have more confidence in Upstart. And it's going to be easier for them to originate more loans. And we're going to be able to see them ease off the credit risk, because they're going to have more of a be more of a staple, because people are going to know them. They survived one of the worst macro events possible for a company like Upstart.
Sure.
And so there's durability and there's credibility that comes with that, just as how they lost credibility on the way down. If they recover, which is what Eddie and I are saying we think is going to happen. If they recover, they're certainly going to gain credibility, and they're going to ramp up for round two. And with these product diversification, these new products and more partners and more capital, hopefully it should be a better run than the first one. So
the only thing I give pushback on that is I don't know how, I know how the stock has performed. I don't think the bank partners are going to care about how their stock performed nearly as much as how their loans have performed.
Yeah,
vintage performance is boosting up. It's coming back up.
But versus competitors, or?
Well, I'm not well versed on every other competitor's metric, but like I said, that's what Upstart's trying to prove right now, is that our vintages are going to give you a higher yield than competitors. That's their job.
Yeah. So that's their only job they have.
Yeah,
Upstart's
right.
Upstart's worst performing vintage returned about 3%, and I believe the target was 9%. So even in the worst case scenario so far that we've seen during the cycle, Upstart was still giving positive returns. It's not like investors or fund managers put money in and then they wound up losing money. They just underperformed what their targets were.
Now I'm curious. So two prong, is that net of fees that you also had to pay to Upstart to also, because if a bank originates it themselves, there is like that's almost like the fund manager versus index fund sort of thing, is you have to get the performance of those loans so much higher than what you also have to pay to Upstart.
Well, I mean, I think that's kind of what you're touching on when you're talking about JP Morgan making a competitor, is that can Upstart returns be so outsized that it's not even worth JP Morgan's time to try and replicate something like that, to just pay the fees. And so I would say that very clearly that was the case in 2021, because everybody was coming on and originating like crazy.
Sure.
And I would say that probably was not the case in 2022 and early 2023, because there weren't as many investors and people weren't buying as many loans. So I think naturally those vintages were probably underperforming. But I think what should be noted is that you touched on it earlier, Tanner, the federal funds rate was raised. Once again, we're at all-time highs, relatively speaking, in this cycle. And
fastest
Upstart
raise ever in history, right? Or something like that.
Something close, like 21 fold in like a year or whatever it was. I think Kathy Wood said that.
That's crazy.
But Upstart let me see if I can share my screen for this chart table type thing so that people can follow along with what I'm talking about here. So,
sure.
Okay. Can you guys see that?
Yep.
Perfect. So if we look at Q1 versus Q2, we can see that revenue grew 32%, and they guided for 140 million roughly in the next quarter, which is somewhat nominal growth. But what's important is that growth is not deaccelerating or going back down. They're treading water at this new base, which is about 135, 140 million. And Upstart believes that their vintage performance bottomed last quarter, as well as their revenue bottomed last quarter. They received up to 4 billion in funding from Castle Lake, 2 billion, which was officially announced in Q1. And I think Sanjay said they used about 1/4 of that to fund new loans in Q2, which attributed to the revenue increase. So there's still a lot of committed capital left, and they're in multiple discussions to get more committed capital. Obviously, a big bull case is if they can continue to bring that committed capital in, and a big bear case is if they can't get that committed capital because Upstart doesn't control their own destiny in that regard. So that's obviously a bear case. But what we can see here is revenue is increasing substantially. Net income improved 78% sequentially from negative 130 million to negative 28 million, which is still about a 50% improvement from Q4 in 2022, where it was negative 55. And then Q3, it's about the same as Q2 of 2022, which was the first down cycle.
Okay.
And so the point that I'm getting with this is Upstart is set up to return to profitability at a lower loan origination scale.
Yeah.
Which is very impressive and something that investors should be happy about. Now, Upstart's guidance reflected losses, kind of giving back some of the gains that they made in this quarter, but nothing is in a vertical line. And somebody's probably going to pick on me for saying that, oh, you're just justifying it, but it is what it is. Of course, you're going to have some give back in expenses. So expenses are going to probably, I think they're guiding for a little bit of an increase. Adjusted EBITDA is going to fall a little bit. They posted 11 million positive in the recent quarter, and they're expected to post 5 million, I believe, positive in the next quarter, which was a big 60% miss according to all the headlines, when in reality it was just like 5 million versus 10 million, like, oh, or like 11 million. Like, it's not that big of a deal because we're dealing at such a small scale. Similarly, if you say revenue is down 66% year over year, yes, is that good? No, but you would have known that before the earnings were announced based on the analyst estimates. So that shouldn't be a deal breaker in your thesis. And as revenue grows in the future, hopefully the comps will look just as ridiculous, but to the upside. And so the other thing I want to point out here is that operating expenses this quarter. So in Q1 of 2023, they were 234.8 million. This most recent quarter, they were 169.10 million. So that's like a 30% drop. I should probably add a column in there, but that's a pretty sizable drop in operating expenses. And it was supported by a 32% increase in revenue, as well as a conversion rate bumping from 8% to 9%, adjusted EPS positive, free cash flow positive. Like this marketing was cut and they still grew revenue. Like this business is running lean right now.
And what was the headcount cut that they did as well?
20%, I think.
That was
So
20%. Okay.
yeah, but now they are hiring very strategically was the word that Dave Gerard, the CEO, used. And they're hiring, I'm following it on LinkedIn. They're hiring big roles like $200,000 a year salaries, like senior product manager and like stuff like that. So pretty big roles. But the thing that I want people to know is to just look at cash. Yes, it's down year over year, but it increased $50 million sequentially. Loans fell sequentially. Total assets fell, but not at the same pace as total liabilities fell. Like this is a fundamentally stronger company as of Q2 2023 than it was in Q1 of 2023. The riskiest point for Upstart.
Can we also go down to key operating metrics? Because I keep pointing this out, and this might be if Eddie is saying that they're starting to offer more small dollar loans and these sorts of things, that essentially percentage of fully automated loans will go up if they're not separating personal loans from small business loans. But that being said, that cohort of new loans that they're giving out, small dollar loans, I am going to assume are going to be much more profitable than their traditional offerings, even though the originations are much lower on I guess per origination basis. Even if it takes 100 of the small dollar loans to make up one personal loan, that is going to be a higher profitable business model. And like everyone worries about or gets excited about, maybe I should say, for AI companies, like, oh, you're going to create the AI so good that they're going to, wipe away their own workforce. It's like, I mean, yeah, that's bad, but as an investor, that's pretty dang good. You know, do you guys see that being I guess a real outcome for Upstart, is that they could continue to cut workforce as their AI gets stronger and stronger? Pressing the button. If it's flashing, you're not. There you go.
Yeah. So I'll hop in here. So I think that. I'm sorry, I forgot the question.
No,
Can
I was
you
just
repeat it,
saying
Ken?
that the fully automated loans kind of taking away from workforce, helping operating expenses going forward, that sort of question.
So I think it's great as an investor. I think that what Upstart is actually going to be doing is they're going to be helping the small. So we got like 5,000 banks in the United States. What Upstart's going to do, like, of course, the big banks are going to come up with their own AI models. Like that's often a bear case that's brought up. And I don't disagree that the big banks are going to come up with their own AI models. Sure. But what I do disagree with is those big banks aren't going to share those AI models with the smaller banks. So you're going to have probably 4,800 banks that need help automating their loan products so that they can give out HELOCs in 5 days, because the big banks are going to be able to figure this out, and they need a partner to do it. And Upstart's going to be that partner. I mean, I hear the argument that automation is going to cause losses in jobs, but that's capitalism. It happens, and it's going to keep happening.
Right. Eddie, can you touch on, just going off that point, they're going to Upstart serve small banks and credit unions well. Can you touch on, you had mentioned it to me earlier, contribution margin has increased so drastically even through the down cycle. Upstart could potentially give back some of that margin to help give their partners higher returns, which other companies may not be able to do.
Yeah. So Upstart, what I believe is going on with Upstart is they have a supply problem. And when you have a supply problem, but not a demand problem, you get to increase prices. And that's what I believe Upstart is doing. And I believe that's being reflected in the contribution margin. I think that Upstart is likely to give away some of that contribution margin to their committed capital partners. And this is just a theory, but I think that should they do that, those committed capital partners are more likely to sign on with Upstart. It's a little carrot to get them to, to commit to billions of dollars in funding, and that can get Upstart's revenues moving again.
That makes me think about PayPal with buy now, pay later, is that they were kind of toting how strong their pricing for buy now, pay later was over the likes of Affirm and such, where PayPal's buy now pay later, they essentially tote as being free, right? They'll make it back just because their transaction margins are so high, versus Affirm where they actually like need some sort of APR, whether it's from the merchant or the consumer. Anyway, I'm getting off topic, but the idea being that PayPal said, okay, well, if you use our buy now pay later, we'll even give you cash back. That's like how excited we are and how much pricing power we have, that we will go above and beyond to show off versus the competitors. And yeah, that's making me think that it's hard whenever your algorithm is that ahead of the others.
Yeah, I think if they can keep increasing that contribution margin, that gives them a lot of optionality as far as what to offer the counterparties to try to get them to take these loans onto their balance sheet so that Upstart can keep doing what it does best, and that is originating loans.
So I don't know much about Pagaya. I do know that they work with SoFi. I know SoFi very well. Whenever SoFi has their own AI algorithms and everything, whenever they don't want the customer, they offer it to Pagaya. And they haven't taken a lot of loans, but I think it's been like 45,000 loans that Pagaya has taken from SoFi and has offered it amongst its marketplace. Is that essentially another revenue stream that Upstart will get into, where, the large banks will also have their own algorithms, but then, Upstart can still have free pickings at their scraps, and let's say a JP Morgan will still service that client, but the actual, what do you call it? Like receivables for that loan will be owned by someone else?
Sure. I think big banks are going to want to serve more affluent borrowers anyway, and they're probably not even going to want to spend a ton of time R&Ding like subprime borrowers or riskier borrowers. And that's the big difference between Pagaya and SoFi lending, between Upstart lending, is that Pagaya and SoFi are lending to much more affluent borrowers than Upstart is. And they're also primarily more so, at least Pagaya is, in the ABS markets. And so when Pagaya grows revenue 8% quarter over quarter, or guides up for 8% or whatever it is, that's great. But it's also a lot easier to get people on board to fund those types of loans than it is unsecured personal loans, which is Upstart's bread and butter. So yes, the two are similar, but Upstart's going to outperform in bull cycles, and Pagaya is probably going to outperform in bear cycles, simply because they have different cyclicality aspects to them. Something additionally that I would mention about Pagaya is Pagaya had a fantastic quarter. I'm not trying to deny that, but the increase in EBITDA is slightly misleading, given that they had front loaded a lot of their listing expenses to become publicly traded, which were reflected in the comparison for this most recent EBITDA announcement. So while EBITDA was certainly a vast improvement, not at the clip that it would have been if expenses weren't just lumped in, the listing expenses weren't just lumped in previously. So certainly Pagaya is a great business, and I have no problems with it at all.
I'm not even really comparing them one-to-one. I was just saying, like, big banks could still offer
they can.
Upstart as like a B offering to say, what, we won't offer it to you, but maybe these guys will go find a lender for you, but we'll still service it on our platform.
Yeah, it's possible. I agree.
At least that's the way I looked at it with SoFi, whereas like for SoFi and Pagaya partnership is like, okay, you know what? At least you can make the client happy by giving them an offering, but we won't have any part in their default. Someone else will, meaningfully take that risk.
Sure. I think that's going to happen across most of Upstart's partners. I think that Upstart's partners they're not, I mean, let's be honest, they're not going to want to use Upstart's model if they think that they can underwrite it. They will try to underwrite it themselves. And if it comes back as rejected, then I believe that they'll go to the Upstart model. I think that'll happen a lot in auto. I think that the Upstart model is going to serve as a backup for lower quality borrowers.
Sure. So, okay, let's I want to hear more about auto, because to me, that's touted as being such a massive market for lending through originations. But I know that Ally's in it. I don't follow them close enough. I don't know too much about auto lending, but it is another massive area that that Upstart could potentially be getting into, right? Like the total addressable market for auto originations is larger than personal loans by quite a large margin.
Yeah.
What is management saying for that? Go ahead.
I'll give you some quick data points that were from Q1 in my Q1 research. So this is last quarter.
Sure.
basically Upstart funded more than 20% of the total funded loans at participating dealerships. So a dealership that is partnered with Upstart, over 20% of the loans funded they're using Upstart, which is a great sign. It's also sticky, which means that it's probably difficult for those those dealerships to move off of Upstart's product, which also translates to what? Pricing power, which is something that Eddie was talking about, hopefully. And when presented with an Upstart loan offer in regards to auto, borrowers chose Upstart 42% of the time. So that's also pretty high given the current macro. And so I would assume that that's likely to increase as well. So auto borrowers saved an average of $5,851 over the life of a loan with Upstart auto refinancing. So there's a lot of things to be excited about with auto, and people are going to be quick to jump to underperforming vintages and loan performance for auto, which is certainly a fair criticism. I already said earlier in this that yes, they were selling some loans in an ABS deal that were marked down, but you can kind of think of it as R&D and it being scalable, because when they do eventually figure out auto, like you said, it's huge TAM, and it could end up eclipsing their total personal loan business. And I'd like to get you the balance numbers for the actual balance, or like when they're issuing a loan, how much that loan is worth. So the average unsecured personal loan for Upstart had a balance of $10,475 last
Okay.
quarter. That's on average how much money they're lending out per unsecured personal loan.
Yeah.
Now for auto, that is $22,151. So it's almost double the size of the personal loans, which they're not going to be as high of an APR, obviously, because it's a secured loan. But still, there's massive room for that to grow. They're not lending on like shit car or bad cars or anything like that. Like these are real loans made on real cars that obviously have some sort of real value. So it's once again reducing the cyclicality of Upstart's business. So yeah, I think auto can become bigger than unsecured personal loans. I think that's probably a long ways out, but they are certainly ramping up quick.
So this comes from someone that doesn't follow Upstart close enough, and that's why I'm reaching out to you guys, because it's an easy way for me to get all this soaked into my brain. They grew their like auto dealerships by like it was like close to double or something. It was like 30 something to 61 or is that not a big deal? I felt like no one was talking about that, but that seemed like they're really ramping up in the amount of dealerships that they're dealing with. That could scale quite large if they continue that pace. Am I incorrect in thinking that?
No, well, very rarely do people say anything positive about Upstart, but Upstart added 12 new states to its auto lending program in Q2, and Upstart's auto program now serves 65% of the U.S. population. So certainly nothing small there at all. They certainly have a presence which is growing and expanding. I mean, 12 new states just in this quarter. Eddie mentioned earlier that they're looking to get into more states for HELOC, including Michigan by Q3. So these product
right
offerings,
now it's just in Colorado, right?
Yep, just pilot in Colorado. But they're taking these product offerings and they are pushing them out farther into more states, which is good, and suggests that it may become larger in the future.
The auto product isn't fully launched yet. But what they've said is once they feel like they've got their models figured out, I also think they're kind of waiting for the liquidity to come back into the market, that they'll basically be able to turn on a light switch and really ramp up revenue really quickly from their auto segment.
Yeah, but that is the craziest part that I find about this business is like there's a little bit of black box theory with, okay, if they get it right and legitimately they might not, right? I guess that's
very
one
possible.
of the biggest.
Very
but
possible.
If they do, it's an overnight success.
Yeah, that's why I like the risk reward for Upstart, because I find it troubling to believe that it would go to zero, because I don't think bankruptcy concerns are on the table. But it's very possible that
I don't think it's bankruptcy. I think it's lack of good AI algorithm, and no one needs them.
But I would say that that's also unlikely, given that they're one of the first. They're basically they call themselves a pioneer. They pioneered like fair lending practices, some organization that works on that. So I think they have certainly a head start. But if Upstart's data doesn't work, then yeah, the company's not going to go anywhere. But on the contrary, if their data does work and everything that they are building does come to fruition, the upside is so high that for me, it mitigates or at least makes the risk attractive for potentially it becoming a dud.
Sure.
If you invest in 10 upstarts and one hits, I think it's the scale at which it's going to hit is going to pay for the 9 upstarts that didn't hit, if that makes sense. So I think there's huge potential here if it works. And so I personally have a small concentrated bet on that happening.
Okay, so let me ask you both, and Eddie, please go first. Today, let's say the stock is about $35 a share. Does the betting begin today, or was the betting obviously it was a lot better when it was like $11, $12, but do you still find this investment attractive at these current prices, knowing what they put out in Q2? You're muted.
You're muted. Yeah, you're muted.
Sorry about that. I personally find Upstart attractive under $40. I think it would be super attractive under $25. I would call, just my opinion, I'd call fair price roughly $50. And I think we're probably going to hang out, plus or minus $10 from 50 until one of these catalysts hits.
Got you. Henry?
Yes. Okay, I'll jump in. I think that Upstart was vastly mispriced when it was under 20 with a lot of the things that we knew were coming. I think a lot of the margin of safety is gone in Upstart. I think you're betting on a stock that more people are aware of what's coming. So I think it's probably fairly priced in the 30s, just about, or maybe even the 40s, I think somewhere around there. But I wouldn't expect this business to catapult immediately. I wouldn't expect outsized returns like we've seen in the past 6 months immediately. I think everything that I'm reading with the data and the way that they're structuring their business is for them to become more durable and weather the storm for however long that takes. UMI, the Upstart Macro Index, is their leading indicator of such.
Right.
And that is still projected to somewhat worsen, which would suggest that their default rates are also going to rise, which would impact losses for loans on their books, right? Fair market write-downs, things of that nature. So certainly not going to be an overnight thing, I don't think, in the recent future. But I do think that Upstart, when the Fed reverses course, I think that's going to be an overnight success. I think there's going to be one quarter where we're totally blown out with a massive guide up, something like 2021. And for me, I'm not going to try and time that. I'm just going to try and I'm personally sitting with what I have, adding on anything that I feel is comfortable and waiting for that moment, which is part of my thesis. So mid 30s, 40s, I think is
you know what?
right.
It's a super exciting investment. I don't hold any right now. But also I wasn't really paying attention to it whenever it was, that low, just because it wasn't in my radar. Now that it is, I'm going to keep a very close eye on it as it gets lower. I'm not buying it in this price range just because, personally, I just find there's other investments for my portfolio. But yeah, congratulations to the people that had gotten in at such a low price earlier this year and went up all the way to $70. I mean, at that point, people were getting out and making a ton of profits. So extremely volatile and wow, very interesting name. And I hope you guys do well in your investments. Thank you for coming on.
Thank you, Tanner. It was great having.
Thanks for having
Great
us.
to be here. Yeah.
Bye for now.